听见资本本期视频为您带来的是摩根士丹利在4月15日的 TMT 闭门会，主题为关税不确定性下的科技周期对 PC、服务器和半导体生产设备的影响及台积电前瞻。科技行业正面临一场风暴，关税的不确定性像乌云一样笼罩着整个市场。科技周期真的已经见底了吗？有分析师警告，市场调整可能还没结束，盈利预测面临着巨大的向下修正风险。在这种环境下，哪些领域相对安全？哪些投资需要格外警惕？芯片行业首当其冲，龙头企业看似稳健的业绩指引背后隐藏着多少变数？客户提前备货带来的短期繁荣能持续多久？被市场热捧的 AI 需求会不会突然降温？关于芯片巨头与英特尔合作的传闻是真是假？又会对行业格局和你的投资产生什么深远影响？再看上游的半导体生产设备领域，日本供应商透露了哪些关键信息？下一代 iPhone 采用的新封装技术，移动设备内存规格的升级，甚至是中国在缺少顶尖光刻机的情况下如何奋力追赶，这些技术变革将如何搅动设备市场的格局？哪些公司会因此受益？哪些又可能面临冲击？下游的科技硬件更是风声鹤唳，新一轮关税成本最终会由谁来承担？你手中的手机、电脑会不会因此涨价？供应链中国加一的多元化布局正在加速，这对现有厂商意味着什么？苹果 PC 厂商最近的订单回暖，究竟是真实需求的复苏，还是寅吃卯粮透支未来的表现？服务器市场，尤其是 AI 服务器领域，最新的设计方案变动又将如何影响相关供应商的业绩和股价？最后，被寄予厚望的人工智能和云服务，难道也要进入周期性调整了吗？有分析师发出警告，云服务提供商的资本开支可能正在见顶。有哪些关键信号预示着风险来临？在这个时间点追高 AI 概念股是不是尤其危险？接下来是英文会议的全部内容。如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Good morning, good afternoon, everyone. This is Charlie Chen, tech analyst at Morgan Stanley. So welcome to our TMT webcast today. I'm the host. So before that, just a reminder, this is for Morgan Stanley clients and financial advisor only. If you are from NVIDIA, please disconnect. And whenever you have any questions during the webcast, please use the ask question function, and I will try to moderate at the end. So today we have a packed schedule. So the common topic should be the tech cycle around this tariff uncertainty, and we are very happy to have our tech upstream, downstream equipment analysts to share with it together. So maybe to begin with, we let Duan, our Asia Tech Strategy team, to share a big picture view, and then I will talk about TSMC's preview, links to Wadaki-san's SPE update, and lastly we have some tech hardware analysts and also Daniel Yan about the PC, Apple supply chain, and also cloud supply chain updates. So Duan, please go ahead. Thank you.
Sure. Thank you, Charlie. So for this time, we want to kind of lead investors to revisit our tech cycle playbook amid this uncertainties and high volatilities. So stock market crashes not on real anomalies, but rather recurring features of the financial markets and also the tech cycles. So for each crisis begins with a shock, and this time we see that the very volatile tariff announcement and followed by immediate market reactions. So we want to bring the tech cycle playbooks back to the table for comparison this time. So in this chart, we see the stocks index performance for this cycle compared to historical average. we can see that market has already coming up from the July peak last year, and we are in the pessimism stage right now in the cycle. But we want to remind investors that for this correction is not done yet. So the 90 days delayed in the tariff only prolongs the uncertainty, but not provide immediate relief. So there are some relief in the economic forecast post-tariff pivots, but the problems with the stock markets had before is they still exist. So we can see that the pull in demand ahead of tariff still boosts the XAI revenue for semiconductor sectors this time in first quarter. And from just our checks with distributors and channels last week, the pull in demand will still persist into the second quarter. But semiconductor revenue has historically been highly related with US ISM PMI index. So if we see the prolonged uncertainty to eventually impact the consumer confidence and enterprise spending into the second half, we see further downside risk into the second half demand for the overall semiconductor supply chain. And if we put the time for perspective this time, and we compare to the 2018 trade war cycle with the current tax cycles, we can see that MSCI Asia IT will fall 25 to 55% on average in each down cycle. And this looks very similar to 2018, where tax cycle declined for 27% in the 2 quarters since its first drawdown in June 2018. So the historical drawdowns were all caused by fears of crisis and recessions that did materialize over the different durations. So the tariff conflict is also much bigger this time, and this being fought on multiple fronts, and that's already happening. And we expect the scale is significantly larger this time. But at the same time, we are seeing that the EPS derating has not started yet, with Asia Tech EPS forecast still at the historical peak currently. So we see the EPS downward revision as the biggest risk in the upcoming quarters for the tech sectors. And as we just mentioned, PMI has indicated forecast for the semiconductor revenues. And if the PMI goes down into the 2018 lows, it will imply negative growth of 10% year over year into the second half 2025. And for the semiconductor revenue, and we see if that really happens, we see the further downward situation for stocks EV to sales multiples, and we see as much as another 13% contraction on the multiples before we're finding a bottom for the market. And for the stock implications, we currently prefer 4 baskets of the stocks. The first is the quality defensive names with the cheap valuation, and for that we highlight Samsung Electronics and Delta. And secondly, we see the China localization secular trends. So we highlight Chinese SPEs, leading node foundries, and EDAs. And thirdly, we see relatively less risk for the China domestic smartphone supply chain, and as well as high China domestic exposures versus overseas exposures. And thirdly, within AI supply chain, we prefer names that are less exposed to tariff risk. And so for our least preferred names, that we want to avoid right now is the high exposure to tariff uncertainties and negotiations. So I will pause here and hand it back to Charlie for sector-specific discussions. Thank you, Charlie.
Thanks, Ron. So indeed, a lot of uncertainty. So usually TSMC should be a high-quality safe harbor in these environments. But I think given two sort of major overhangs, one is Intel JV discussion, and also whether there's a AI demand issue, right? Meaning CoWoS capacity slowdown or cuts. I think those are kind of two overhangs right now. But let me try best to navigate in this uncertainty. So into the point, we have a view that probably TSMC wouldn't cut the full year revenue guidance yet. Simply, customers just don't know. And I think to be prudent, maybe not to cut for customers, but collect more feedback in the coming 3 months and give that update in July. Right. So I think my view is that the TSMC will keep a full year guidance to be up 25% YoY. CapEx remain to be $40 billion. So maybe Wadaki-san later can talk about his view on SPE implication. In terms of 2Q, I would think a revenue to be up 4% to catch up the 4 nanometer. And we do hear 4 nanometer utilization is super busy still. In terms of the revenue forecast, we do trim our forecast a little bit to reflect some consumer tech weakness, right? But for whether AI revenue will be impact, I think that depends on lots of factors, including whether AI servers will be tariffed. If that's the case, whether downstream can relocate the shipments, and even in the case whether CSPs they are still holding up their same capex amid some uncertainty of U.S. economy recession. But anyway, I think there's a preview itself, and I want to touch base a little bit on the recent question about the AI demand. So we really don't hear NVIDIA cutting CoWoS capacity this year. It remains to be the same. I think the dynamic is more on the downstream side. Cordelia boards that get delayed, but Bianca could be the major format for the coming GB300 server. In that case, we don't see any cuts from NVIDIA, but we do introduce a 2026 CoWoS capacity a little bit conservative. Initially, 90K wafer per month for next year to reflect around the year end. Probably there could be sufficient chip inventory, right? So we wanted to play by ear. So maybe Wadaki-san can also comment on advanced packaging CapEx trend. Testing wise, still very strong. We heard from KYEC that gaming graphic now is occupy the most of testers' capacity. If you look at this chart, it's a gaming graphics spot price in China. I think that's probably related to the DeepSeek or China AI inferencing demand continue to go up, right? So Blackwell now still cannot get a sufficient testing capacity. I think that's probably I wanted to share. For Intel JV, our view is that it doesn't make sense to both TSMC and Intel because of lots of reasons. But the key is that we hope TSMC can make it clear role about their stance, whether their U.S. investments is good enough, right, to exchange the tariff exemption on semiconductor and also put off this Intel JV from the table. Yeah, with that, I will hand it over to Wadaki-san about Japan SPE update. Thank you.
Thank you. Yes, I'm Tetsuya Zaki. I cover Japanese SP sector, and this sector have several hot topics now. This Thursday, DISCO will release their earnings results on March 2025, and biggest forecast is their shipment. President last month said that utilization is now only 90% and will decline to 70%. So every investor have a concern that this shipment shipment forecast become very low level. But we think this Friday, President will attend the earnings conference, and I expect that President will give the positive outlook in their business in mid-term. I already gave 3 topics that can drive the DISCO and back-end equipment market driven by these topics. First is COWR, chip-on-wafer RDL. Yeah, this year, one of the biggest topics is iPhone's new packages. iPhone will change their packages from info to COWR since 10 years ago. And of course, there are some risks that Apple push out this plan. But currently, iPhone 18 will use these packages, and CapEx will come in this second half. And several of my contacts said to me, some of the material maker and equipment maker already received the inquiry of these packages. And COW's business volume, my contact in semiconductor equipment company said become more than 3 times as much as info. So I think DISCO and several companies will have a meaningful business opportunity of COR in this second half. And the second topics, new DRAM for this mobile phone. And this new packages will use new higher bandwidth DRAMs. And my contact in semiconductor equipment maker said Samsung is now preparing to provide this DRAM to Apple. I think, of course, Samsung have not a meaningful volume of the job of HBM, so we think this company discounted to get Apple's business. And this DRAM have a whole layers. And tester maker already received the big order from this business. So I think probe card maker like Micronix Japan and DISCO will receive the businesses for these opportunities. And third is panel level packages. And now Taiwanese biggest maker, my contact in equipment maker said TSMC already gave the inquiries for panel level packages equipment to make mini lines. But mass production will not come soon. Yeah, equipment maker said to me, mass production will come to 2030 much later than this time. But some of the business will come to Japanese SP makers. So I still like DISCO. Clearly, this is because stock price already fell down based on the misleading comments of the president. But there are many business opportunities in second half, COWR, new mobile DRAMs. And China SP market also affected each SP maker's business environment. I think U.S. government will not allow current situation that Chinese semiconductor technology become higher than Intel's semiconductor technologies. Yeah, and Charlie-san already reported that SMIC will challenge 3 nanometer or 4 nanometer, and Intel is still traveling about 5 nanometer. And but SMIC China have no EUV. One candidate is Octoprint, And octoprene spacer process 3 times, and line and space become only 1/8 from single patterning. And etching process will become 11 times. Quadruplene is 8 times. And deposition becomes 7 from 6. Atomic layer deposition becomes 3 from 2. Litho 2 times, not changed. And cleaning system will increase 11 from 8. So if octoprene used in mass production, etcher maker looks like interesting. So my conclusion, back-end equipment in a company like Risco, Tokyo Semis, Micronics, Advantest looks like interesting. Thank you, Charlie. I pass to you.
Thanks, Waraki-san. So let me and Waraki-san quickly answer a few questions on our sector. So yes, we still like TSMC, and Waraki-san still like Disco. And for TSMC, I think it's just some overhangs on the Intel JV, semiconductor tariff exemption, and also the cost capacity expansion, right? But our view is that those 3 overhangs could be quickly removed in the coming months, and share price should quickly rebound. Another one is more technical. It's about iPhone processor change to CoWoS-R. I think we clarified this, right? It's not CoWoS. It's info kind of packaging, right? So it doesn't really need a substrate. So there's a kind of some additional equipment required to convert that original info to the multi-chip info, but additional CapEx spending is not very, very heavy. And I wouldn't call it a COWR. I think it's some wrong information from one of the Taiwan equipment vendor. And number 3 is the view on TSMC CapEx in the coming years. With the U.S. exemption, do we expect the CapEx to grow in line with the revenue? So TSMC made it very clearly. The U.S. CapEx is not kind of addition to total CapEx. It's just more a mix from Taiwan shifting to the U.S. investments, right? So Taiwan capacity or CapEx still grow, but not as fast as the U.S. Expansion. So in terms of the mid to long-term CapEx, I would think stay at around the $40 billion US dollars level, because they already capture the major expansion in the US and also Intel outsourcing opportunity. And with that, the capital intensity probably will gradually decline to low 30%, even 30%. So in that case, I think revenue should outgrow CapEx in the coming years. Yeah, there's another question, but I think I need that time to digest. So maybe we now move to Sharon, Howard, and Daniel, the tariff impact to your sector. So Sharon, please go ahead. Thank you.
Yeah, thank you, Charlie. So let me start for the top-down view for the overall tech hardware sector, and then I will focus on the latest for Apple supply chain, and then pass it to Howard for his latest view on PC, server, and also ABF substrate. So definitely for this tariff increase, no one will be able to be immune from the impact for overall tech hardware sectors. In the past, the incremental tariff cost is normally shared by the brand customers, supply chain, and also the end consumers. So far, we definitely see there is a 90-day pause for this potential bilateral discussion on the final tariff policy. but just we do believe that near term, for any of the tariff increase, it's going to be probably pass it to the end product price, meaning that the supply chain won't be able to adjust the production cost or supply chain location, etc. so soon. So for the brand names to avoid the impact on margin, they are going to pass some of those price increase to the consumers, and we already see that happen for some of the notebook brands. For mid to long term, our view is that basically the tariff cost will be shared by across the supply chain, but just in terms of the share split, it's going to depend on the respective bargaining power in our view. Regardless of the final result of the tariff, we do believe that the overall supply chain will look to for accelerate the production location. It's going to become much more regional going forward. Right now, most of the tech hardware supply chain has been already doing so-called China Plus One. The Plus One location is highly concentrated in Southeast Asia and also India. Whether to add new production capacity in the U.S., that's going to be subject for further discussion. But for most of the ODM and the components we talk to, basically the response of the potential addition to the U.S. exposure, the incremental cost needs to be absorbed by the customers. At least the supply chain will reflect the incremental cost to the new price quote. So in terms of the stock positioning, again, we do believe that the consumer-related tech products, including iPhone, iPad, will face greater impact because of the price inflation potentially will impact the demand. We still believe that the data center infrastructure still sees a much more resilient shipment momentum. We do think that it's better for the data center infrastructure supply chain. We also think longer term for those global supply share leader as well as technology leader will be better off. Regarding the latest Apple supply chain, for this monthly data book that we just published, we raised our iPhone and iPad build for second quarter. Again, this is to reflect the early pull-in momentum ahead of any tariff impact. This is not a reflection of demand strength. For iPhone production, the iPhone build for second quarter, we raised 4 million units built for second quarter. Total second quarter iPhone builds now is at 45 million units. These suggests a up 15% year over year. So this also suggests that for total iPhone build in first half this year, that will be able to grow by 9% year over year. Assuming there is no demand change, as we now expect that total iPhone builds this year to be flat year over year, so potentially that would suggest all the pull-in strength is actually at the expense of the future order momentum. So that also means the iPhone built in second half of the year could be potentially on a decline on year over year basis and likely to decline by mid-single digit year over year based on the current assumption. Regarding the iPhone production location, by year 2024, close to 90% of the iPhone still produced in China. Definitely, Hon Hai as well as Tata and also Pegatron will trying to accelerate the iPhone shipment output from India this year. Even assume they will be able to double the output from India this year. That would be roughly total close to 40 million units. That again, comparing to the U.S. iPhone shipments a year at 60 to 70 million units, this is still not big enough for the India output. So that's the reason why we do think that there could be further development in terms of production location diversification for iPhone production. But just at this point, we probably still need to wait a little bit for further developments. So with that, let me pass it to Howard for the rest of the tech hardware related.
Sure. Thanks, Sharon. So first on server space, I think what we've seen in Q1 is a pull forward in terms of server demand, particularly around general servers, which I think you can see by monthly revenues from WeWin and Quanta. They were all exceptionally strong throughout the first quarter. So this is a lot of pull-in related to tariff uncertainty ahead of April 2nd. And so in terms of momentum, we do think for general server, momentum will likely be a bit slow going into Q2 versus historical seasonality. And in terms of AI, what we're seeing is, yield rates for GB200 continues to improve. And so output will continue to grow coming into Q2. And so from that perspective, we think in the near term, it's best to be positioned in the AI supply chain, especially since we believe AI is a bit more defensive versus other areas of tech when macro and policy uncertainties are very high. The latest change that we're hearing in terms of NVIDIA supply chain is we are hearing, as Charlie mentioned earlier, a change in terms of design for the GB300 board, changing from Cordelia back to Bianca. Of course, with NVIDIA, there is never, the change is never finalized. And so it's still, subject to change as GB300 is not ramping up until later this year. But this is what we're hearing in terms of the latest. So what this means to our coverage is with the original Cordelia board design, there was going to be an adoption of GPU socket as well as SOCAMM connectors for DRAM. If the design is changed back to Bianca, then these two things will no longer be used. And so the implication to our coverage is that it will be a negative impact on those who is qualifying for GPU sockets right now and have already been qualified for SOCAMM connectors for DRAM. It will also be slightly negative to the board level assemblers like Wistron because the content value for OEM plus UBB under the Cordelia architecture is slightly higher than that of Bianca. And so this design change will be a slight negative to the board level assemblers like Wistron and Hanhai. And in terms of the positive is with the Cordelia, the PCB design is designed with the multi-layer PCB. And so going back to Bianca, that means the design will likely switch back to an HDI PCB, which will have some positive implications to Unimicron under our coverage, who is currently a main supplier of HDI PCB for these Bianca boards for GB200. So that's the latest we're hearing. And in terms of other data points around NVIDIA supply chain is we are hearing, Hopper demand increasing. I think that's consistent with Charlie's checks from KYEC. But also the schedule for GB300 for downstream appears to have been pushed out a little bit, which is consistent with what Joe has been mentioning before, that GB200 yield rates have improved. And so there's no reason for NVIDIA to pull forward GB300, and that they will try to prolong the life cycle of GB200. So, that is quite good. And in terms of the PC space, what we're seeing now is, so if you look at the Q1 notebook builds, Q1 builds were 5% above our estimate. And so this is pre-build for the US market in terms of just ahead of the tariffs. So we think this is mainly driven by brands that have that don't have enough capacity outside of China. So it's brands like HP, Apple, Acer, and ASUS, and even Lenovo. And so if you look at which ODMs have materially outperformed, you can see that it's mainly guys like Quanta and Inventec that were shipping more than our initial expectation. Dell, on the other hand, has sufficient capacity ex-China, and so there was not a lot of pre-build for Dell in Q1. And you can see that by Wistron and Compal's build number. It wasn't materially higher than what we were forecasting and what the company had guided for. So based on the recent kind of tariff pause, we do think Q2, it is very likely that the PC brands will look to build more. And so even after a very strong Q1, we raised our Q2 build forecast a little bit. So now we're at about up 6% sequentially for aggregate top 5 notebook ODM builds. This is still below seasonality just because of how strong Q1 is. But we think the brands will likely take advantage of the near term to build more inventory. We think US notebook inventory right now is between 7 to 15 weeks. So not quite enough to last a full quarter. So very likely they will look to build a little bit more in the near term during this 90-day pause. So that's on the PC side. In terms of end demand, we haven't seen any material pickup. So that's something that we are still closely monitoring. So all of this recent strength is mostly just inventory builds. And then lastly, on the ABF side is we earlier today upgraded Unimicron and Kinsus to equal weight. So we've been bearish on this space for about 3 years. With the recent pullback and the earnings cuts that we've been seeing over the past 3 years, we feel like the earnings cuts have largely finished and valuations now look more fair. And so that's why we upgraded these two stocks to equal weight. The reason why we're not overweight is because this is mostly just a valuation call. Fundamentally, we're not seeing any meaningful improvements. In terms of supply and demand for ABF, we still don't think it will be balanced until end of 2027. So in the near term, although utilization rates are improving, we do think this improvement will be quite bumpy. So this is mainly a valuation call for us. We feel like these stocks have largely bottomed out, and we're just turning less negative and not positive on this space. So that's it from my end, and I'll pass it back to Charlie.
Thanks, Howard. And last but not least, Daniel has been playing devil's advocate to the supply chain. So Daniel just downgraded PCME around its tariff risk, and also he also picked up some kind of concerns around the AI server supply chain. So we want to keep it healthy and constructive on those debates. So Daniel, without further ado, can you share with your latest thoughts on PC and also cloud supply chain? Thank you.
Sure. Thanks, Charlie. First, on the PC semiconductor side, we actually turned negative, more selective on the PC starting from Computex last year, because we found out that there's no killer application plus high pricing for PC, which means very, very hard for the replacement cycle to work. Now, after 1 year, now we are turning overall bearish. All the PC stocks recover. We have no overweight on PC semis. Even our for some company like as media used to be our topic, we don't think it will work under this environment. There are two charts we are looking at. First, on the left-hand chart, we are seeing the meaningful gap between the PC component shipment versus the downstream ODM. I think Howard already mentioned that the downstream ODM has seen some upside on the inventory overbuild. But if we look at the upstream, for example, Realtek revenue up almost 40% year over year in 1Q. As media revenue almost up 30% year over year in 1Q, but PC shipment is up only 5%. So it's a very big gap. And I think during this environment, this kind of gap could continue given the inventory build into second quarter. But that also means we are highly likely to see a deceleration or even decline sequentially into second half. On the right-hand chart, this is from our US CIO survey. According to Eric Woodring, I think PC is among the top 5 cut list from the CIO. And I think right now, also we don't see, even for our firm, we don't see AI PC being the key investment because most of the investment on AI is based on cloud. That's the reason why we turn overall on PC, and we do expect earnings revision breadth to turn negative into the second half. Moving to cloud, I think for cloud, to step back from all the data points, I want to focus on the cloud CapEx cycle. I joined Charlie's team in 2016, and now there are already 3 cycles for the cloud CapEx. So I just use SPE as an example to look at their share price. Again, cloud, AI, these are all constructive trends. And I think from Sharon, from Howard, we all like AI in the longer term. But there will be cycle. Just like in the past years, we see, for example, like SPE during the downturn, the share price usually cut by half in 2 to 3 quarters. That's in 2018. That's also in 2022. So how should we think about this time? Look at this chart on the right-hand side. For this company, the peak is when the earnings revision peak, and also the company keeps revising up their content in GB200. The market expectation is too high. The earnings revision hit the peak. And we also see that for the cloud CapEx already peaking 4Q. So this is the reason why in September 2024, we turned negative on cloud semis, because if I look at some of the signposts we are checking, I think it's time to turn negative on cloud semis, especially we are looking at the cloud CapEx year over year. So how should we think about into second half this year? There are 5 signposts that we are looking at. First is still this cloud CapEx year over year. I think we are highly likely to see the ongoing deceleration all the way to the end of this year. And usually the time to buy is that when the cloud CapEx hit the trough. Second is on the supplier adjustment, order adjustment. I think according to Howard Sharon, I think there are some adjustments on the rack system. But so far, I think price anymore. It's not like 4Q last year when there's a debate. To me, right now it sounds no debate because the delay is a consensus. So if this continues into second half, it's a positive sign. Third, from a customer perspective, we already see some CSP turning negative on cloud CapEx commentary, for example, from Microsoft, while others are very positive. Usually the trough is when all the CSP or most of the CSP cut their CapEx. That's the trough. Fourth, earnings revision breadth. For example, for the chart here on the bottom side, if the earnings revision really hit a very negative territory, then it's time to buy. And fifth is the macro, especially on the tariff. So if I combine all this together as we are into the second quarter of the cloud CapEx downturn, I think at some point in second half of this year, we need to buy all this stuff back. And I will keep tracking these 5 signposts to update to you if there's any new update. So that's from my side, and I will hand over back to Charlie.
Thanks, Daniel, for your very honest and friendly reminder for those supply chain risks. So I think we have like last 2 to 3 minutes to go through some reserve questions. I think smartphone piece supply chain, high risk, potential loser cost. I think that could be already addressed. So let me focus on some semiconductor related questions. First one is about whether the tariff on semiconductors is included in the system or is a separate stuff. I tend to think it's a separate because I think very early on, Mr. Trump already talked about kind of a tariff on semiconductor to force manufacturing back to the U.S. And whether that links to the final systems tariff, I think maybe is about the U.S. content stuff. But I think that's just some direction. It remains to be seen for the coming policy in this week. And the second question is about risk to TSMC's margin. I think, I'm not super clear about the which part of the risk, right? But if you are talking about the U.S. expansion impact to company's margin, I think there is still 2 to 3% dilution, and it is manageable, right? Because for the U.S., the scale will improve, ecosystem will be more mature. So permanently, there's still kind of a below corporate average, but the U.S. margin itself can improve over time. And regarding the tariff impact to margin, I think this depends on fab utilization. So I think it's more cyclical. And there's a question about do we expect that TSMC will come up with some denial about the Intel JV on Thursday call, and what we expect that they're going to say. So it depends on whether or how analysts asking this question, because it's going to be a call. It's not going to be a live interaction. So it will be harder to predict. But the question or the way I would ask is that whether the U.S. administration is happy enough with your current commitments, and if you need to operate out of fab, whether that kind of will impact or distract your focus. So I think that way probably they are more comfortable to answer instead of dictating U.S. administration's determination on this Intel JV. And also I would ask if you don't consider this Intel JV possibility, what would be the reason, right? So if they answer very thoroughly about why they don't consider, then I think that I think is a sort of denial as well, and share price probably will respond positively. And one question again on TSMC, 53% gross margin for TSMC is that a kind of floor, or could it go lower? I think my expectation for long-term margin is somewhere between 55% to 60%, depending on where we are in the cycle, even with the growing overseas fab percentage. For example, for this quarter, we are previewing margin is going to be 58%, even with the overseas fab dilution. So the only bear case that I can picture that the margin structurally will go below 53% is that TSMC is forced to do the Intel JV and with the control interest, and that need to be consolidated into the financial statements. Because Intel is burning like $10 billion cash for those of manufacturing. That is only a bear case, and that's why I believe most of the managers are so concerned about this Intel JV becomes a case. Yeah, sorry, we already overrun 15 minutes. We have to conclude our webcast here. Thanks for your participation and all the speakers. We'll see you next week.